Hello everyone, welcome back. My name is Arias, and today we're going to be talking about Lemonade's Q2 earnings report. I'll review the financials and give my thoughts on the shareholder letter and conference call before revealing what I'm doing with my Lemonade stock. Don't forget to like and subscribe if you enjoy this type of content, and please leave any video suggestions and feedback in the comments below. And without further ado, let's get into it. First, let's get into their financials. They reported IFP of $458 million, up 54% year over year. This was a slight beat over their guide for the quarter of $445 to $450 million. Making up the rise in IFP was average premium per customer of $290, up 18% year over year, and total customers of 1.58 million, up 31% year over year. They reported a loss ratio of 86%, an increase of 12% year over year. This is still elevated from their loss ratios they had around when they went public, but they gave some optimism for its improvement later in the letter. They reported gross earned premiums of $107 million, which is up 60% year over year. Keep in mind that these metrics do not include the impact of Metromile, as the deal closed in the start of Q3. I cannot emphasize enough how good of a deal I think this was for Lemonade's shareholders. For $145 million with Lemonade stock, we received $155 million in cash, added $110 million in IFP, car insurance licenses in 49 states, talent who is doing similar type of work as Lemonade that they would need to hire anyways to keep growing, and perhaps most importantly, loads of data that can be used to massively improve their car insurance pricing algorithm. This acquisition, in my opinion, will only help Lemonade accelerate on their path to becoming the massive company we all want them to be. Most of the doubts that I have heard around the acquisition is based off Metromile's losses and cash burn. However, most of these worries should be quashed when they see Lemonade's full-year EBITDA guidance later in the video. Moving on to the body of the shareholder letter, which I thought was a masterpiece. They started off by reminding shareholders how relatively little their results were affected by all of the global turmoil because they provide insurance, a very stable business, rather than something like advertising or car sales, which are very cyclical. The one part of that global turmoil that has hit them hard is inflation, and we can clearly see that in their loss ratio. However, they've made over 100 filings in the last 12 months to have this changed and expect to see the results help move their loss ratio back in line. They reaffirmed that Q3 of this year will be their peak losses and that EBITDA should improve from then on. In a big change, they also said that they have moderated hiring and growth spending enough to make their current runway of capital get all the way to profitability. This is a big surprise to me, not that they had enough capital on hand to get profitability, but that they had made the choice to take a step back and moderate spending. They also massively guided up their 2022 EBITDA as a result of this moderated spending. They are previously guiding just the Lemonade business to have full year 2022 EBITDA of negative $280 to negative $265 million. Metromile had first half EBITDA of negative $45 million. Assuming this remains steady for the second half, the combined businesses would have looked at roughly $310 to $325 million in EBITDA losses for 2022. However, they guided to beat this projection by roughly $70 million and accrue $240 to $245 million in EBITDA losses. This is of course good to see Lemonade inching closer to profitability in a rough time for the overall markets. Of course, this improved EBITDA outlook comes at the expense of something, and that something is IFP growth. They previously guided for IFP at the end of 2022 of $545 to $535 million for just the Lemonade business on its own. Again, for reference, Metromile ended Q2 with IFP of $113 million. I assumed we could essentially tack on this much IFP to Lemonade's guidance to get a sense for the full year, but the moderated spend outlook has revised this to a large degree. The new full-year guidance for the combined Metromile and Lemonade business is for $610 to $615 million, which is about $40 million worse than I was previously expecting. While you never want to see management revising down growth targets for the year, I again think this is the right move for the company at this time. Management was very clear to say this is not a change of course, but just a change of pace, meaning that they still see Lemonade growing into a massive insurance giant. However, it's going to take a bit longer than expected because the market has not favored them, making it harder to raise capital. They used the analogy of when gas is expensive, you go a bit slower, closer to the optimal speed for miles per gallon, to save a little money. Versus when gas is cheap, you drive closer to the speed limit to get to your destination faster, despite burning more gas and spending more money to go the same distance. Now, I know basically no one actually does this, but this analogy still holds true. Capital is expensive, so they need to optimize their current capital to take them as far as possible. They also reassured investors that growing too slow will be just as efficient as growing too fast, and that they are still seeing double-digit revenue growth going far out into the future. They were also very clear, both in the letter and on the call, that growth plans will adapt to market conditions. This means they will revise their growth outlook higher if the market conditions make it prudent to do so. So, if their valuation skyrockets, they will raise more money and spend it to grow faster. And if not, they'll sit tight and keep on this current path. While I am disappointed to see slower growth, I appreciate the clarity that the management is providing, and I agree with their approach. Moving on, they gave some more details on the Metromile acquisition. They said they'd added 80% of Metromile staff. This was one of their main reasons for the acquisition, adding talent already in the AssureTech arena that they were going to need to add anyways to keep growing. After the completion of this acquisition, renters insurance now only comprises 1/3 of their book, while car went from 1% to 20% overnight. However, they're going to be patient and wait for Lemonade Car to roll out rather than acquire more customers from Metromile in the meantime. I think this is a good and obvious strategy, as the long-term vision will be to have everything under Lemonade's brand rather than the Metromile. That being said, the acquisition opens up 7 more markets that now have the potential for bundling while we wait for Lemonade Car in those areas. This bundling or cross-selling behavior is a key part of Lemonade's long-term business strategy. These customers that purchase another product with Lemonade give them additional IFP without any additional marketing spend from the company. This is a key portion of the LTV to CAC ratio that makes it easier for Lemonade to acquire customers than other insurance tech companies who only have one product. These bundles and cross-sells have been trending up as well outside of car insurance, as you can see in the chart in the top right corner. Car will only serve to improve these numbers further, as many Lemonade customers have a car but cannot insure it with Lemonade at this time because it is not available in their area just yet. But once it is, some of them will choose to insure it with Lemonade, and that will bear fruit in this arena, as we can already see in the numbers from Illinois, where car has been available for a few months. 36% of sales were upsells, 15 points higher than elsewhere. Annual dollar retention, or ADR, was also much higher at 93% in Illinois versus 80% elsewhere. If these trends that we have seen in Illinois play out elsewhere, and I expect them to, it will have an awesome effect on Lemonade's business. Moving on, management reiterated that they're fast approaching the tipping point of profitability. This is the point where their seasoned book of business is sufficiently larger than their book of new business, that the seasoned book of business is generating enough profit to make up for the new book. This is how the business was intended to work, and I take solace in the solid execution towards a long-term goal. They also said that they will hold an investor day in November of this year and fully unpack their path of profitability and show the leading indicators that they use to run the business on a product-by-product basis. Another YouTuber, Paper Bag Investor, called this perfectly in a recent video, so props to him for nailing this prediction. On the reinsurance front, they will be stepping down from 75% to 55%, which just means that they will take on more of the risk of their book of business and will have to hold more dollars in reserve per dollar of business as required by the regulatory authorities. Keep in mind that this change will positively impact GAAP revenue and distort the year-over-year growth rates for the next year. This is why I choose to focus more on IFP, as IFP will not be distorted in this way. As for Metromile's business, they will stay under their current reinsurance rate of 30%, and this will be rolled into Lemonade's reinsurance program next year as Metromile's expires. Moving on to what I consider to be the best part of their letter. They started this section by pointing out that their loss ratio has been on a 3-quarter decline from 96% to 90% to 86% this quarter. While they do expect this to continue in non-Metromile products, they are expecting Metromile to add 3 to 5 points to this loss ratio in the coming quarters. Then they dove into LTV6, a machine learning model that predicts loss ratio, which launched in Q2, replacing LTV5. For each customer added, LTV6 predicts likelihood of churn, claim, and cross-sell, and derives from that the lifetime value. It was trained on over 100 million parameters and incorporates a state-of-the-art natural catastrophe model as well. They use this model to score every product in every market and every ad campaign, and then determine where their dollars would most effectively be spent. They also gave an example of how LTV6 made a change from LTV5. LTV5 scored some California homeowners policies favorable. However, LTV6 revealed that these are more likely to become loss-making over time, while scoring their pet policies more favorably than LTV5 in many geographies. They thus shifted this spend away from California homeowners policies and towards those pet policies that were scored more favorably. This change, and many others like it, was put in place last quarter, but will not show up on their financials for some time, making loss ratio a lagging indicator rather than a leading one. Changes like this are a daily occurrence at Lemonade as they adjust their ad spend as the results roll in. This is yet another example of how multi-channel, multi-market, multi-product approach provides tons of flexibility to the business over a single product line business. I also see this becoming potentially a great proof point for Lemonade to be able to build credibility by saying, remember when we made these predictions? Well, they came true. That would help investors' belief both in the management team and in Lemonade's machine learning prowess. This example is a great look into how exactly Lemonade runs their business, and I am excited to see it continue at their investor day. Management continued their discussion of LTV6 by reminding investors that the amount of data to train large machine learning models on is increasing rapidly. Their first production model, LTV4, was put into play about a year ago, using data from the last 4 years of business. Since then, the number of claims has approximately doubled, which is a massive amount of data to train and improve with. They also show this very intriguing chart displaying LTV6's projected lifetime loss ratio per cohort of acquired customers over the past 6 quarters. As you can see, it's projecting excellent loss ratios of below 70% for the customers acquired in the most recent quarters. Now, of course, this is the case that it thinks that these customers it told Lemonade to acquire when it was in use last quarter will be the most profitable, so there's definitely some recursive element in play here. But I think again, this will be super interesting to look back on in a few years and to see where all these predictions played out in reality. Another factor to consider in projecting better loss ratios for this quarter's cohort is with pulled back spending, Lemonade would have been targeting only the best candidates for their service and therefore potentially improving loss ratio by selecting out the weaker candidates by not advertising to them. This may not have had much of an effect, as they may have only seriously moderated gross spending into this current quarter, but is nonetheless something to look out for going forward. Moving back to loss ratios, Lemonade's management reminded us that its customers' loss ratio tends to be higher when they are early on in their life cycle, and it takes them about 2 years on average for this loss ratio to intersect with their average lifetime loss ratio, after which they're below it. All that being said, 73% of Lemonade's premiums have been with the company for less than 2 years, meaning there is still much seasoning to do with Lemonade's book and much more of this natural improvement to be had. This is the opposite situation for incumbents that we need to keep in mind while evaluating Lemonade's loss ratio. It looks worse than it will look in the long term. And this is another reason these LTV machine learning models can be so useful in the long term, if accurate, is they can provide a leading indicator on loss ratio long term. It will allow Lemonade to use forward-looking indicators to optimize their business better long term rather than looking at backwards indicators like a loss ratio. Now let's move on to some notes from their conference call. On the call, management said that they had deliberately slowed the growth in CAR to avoid excess losses, and with a new focus on conserving cash burn, they would need to improve their loss ratio here before ramping up spending in this area. This makes sense for a company focused on conserving cash. Newer products tend to have higher loss ratios because Lemonade has a less refined spending regime with said products, and while it's too bad to see Lemonade throttling a major source of growth, for the time being it's a prudent move given the cost of capital and how large the losses could be early on in CAR's life cycle. The buyback question got asked again as well, and Lemonade put this one down pretty quickly, saying that buybacks are for companies with excess capital and not excess opportunity, and Lemonade is firmly part of the group with excess opportunity. CFO Tim Bixby pointed out that the average Lemonade customer after the Metromile acquisition has an average premium of about $300 a year or so. However, as these customers grow, this could easily become $3,000 a year if a customer has multiple products with Lemonade. Of course, this won't happen with every customer, but the fact that you could have a 10x or more in spending over a lifetime with a customer is somewhat rare in the tech space and really changes the LTV to CAC dynamics. CEO Daniel Schreiber reminded investors of the benefits of having a digital-first platform when he said that the volume of claims helps Lemonade rather than hurting them because, while they do need to scale headcount somewhat because humans are involved in 1/3 of the claims, it also gives them more data to improve their algorithms, as they mentioned earlier. Finally, for this slide, management made an interesting note when they said that they could have no reinsurance and still be comfortable with their current amount of capital. This is no surprise for the time being, with their ratio of IFP to capital being what it is. However, it will be an important factor to watch going forward, as it could force Lemonade to do a raise in a bad environment if they grow too quickly. Before my conclusions, let's talk about a few potential ideas that I've heard recently that could provide some sort of moonshot upside for Lemonade. The first, I believe I heard from Paper Bag Investor in one of his recent videos, is Lemonade partnering with Cash App and Block to provide Lemonade's insurance right in Cash App. Needless to say, this has the potential to drive many new users to Lemonade, with Cash App having nearly 50 million monthly active users, while Lemonade has less than 2 million customers. If just 2% of Cash App's MAUs signed up, that would add over 50% to Lemonade's customer count, which would be huge for the business. Block would also make out like a bandit on these sales and kickbacks, and I'd imagine Lemonade could get similar unit economics because instead of paying advertisers for the sign-up, they could instead pay Cash App. They could also streamline the payment process through Cash App, and this could drive further inflows for Cash App, which is one of their key metrics. They could even deepen the partnership and provide data from Cash App to Lemonade to help Lemonade determine who would be a better customer, although there are probably privacy issues there, so I find this very unlikely. I do not believe that Block yet offers any insurance products. However, their mission is economic empowerment, and thus I'm sure this is in their product pipeline somewhere. They could, however, simplify their life greatly by just partnering with Lemonade, who already has all of the key elements built. They could also partner with Lemonade to build some small business insurance. I think this is a product that will be in Lemonade's scope at some point, and Square will be an excellent distribution channel with all of their small businesses already on board. I think Lemonade is well suited for small business insurance and will eventually launch a product at some point with or without Square. However, I think there's a decent chance of these two coming together at some point because I think they could both benefit majorly from their alignment, and thus I'd give it around a 25% chance of these two businesses partnering. The next idea I consider much less likely, and that is Apple and Lemonade partnering up to provide health insurance via Apple's line of products. This is an idea I got from the Twitter username on screen right now, and you should check them out for a much better look into it. The idea involves harnessing Apple's devices and health data to provide health insurance. This can be done, in my opinion, and will be very successful, but I think Apple will likely do this by themselves. They have plenty of machine learning talent and a trusted brand, which is what Lemonade would be bringing to the table in this partnership. I think this is also a very important product in Apple's roadmap, and thus I think they'll keep it in-house. If it were to happen, it would be huge for Lemonade, but again, I assign a very low chance of it happening. I am more bullish, however, on Lemonade in the very long term getting into health insurance. Management has thrown cold water on the idea when it was brought up in the past, but I think Lemonade could bring a lot here, especially by making it easier to understand by building the products from scratch to be user-friendly. There is a lot to be improved here, but if it seems that the regulators in their current markets move slow, I can only imagine the regulators in health insurance are even slower and more convoluted, and this is what I think will ultimately keep Lemonade out of the market for the time being. Finally, for my conclusions. This is a very strong quarter for Lemonade, all things considered. However, I'll be very interested to see a few things. The first being whether their projections for their growth next year. It will be in the double digits, over 10%, but I think less than 50%. But where does it fall in that range? Closer to 40% or closer to 20%? We'll have to wait and see. Next, I would be interested to see if we can get management to commit to a year to becoming profitable, and maybe an interim IFP growth projection. From there, we could learn many useful things about where they expect the business to be over the next few years. I will also be interested to see if the market conditions improve and if the cost of capital comes down enough for them to raise money and accelerate growth going forward. As for what I'm doing with my Lemonade stock, I'm interested in purchasing more, especially if the shares were to return to below $20. For the time being, though, I am standing pat and building up some cash to deploy later. After this current rally, Lemonade currently makes up about 5.5% of my portfolio, or 19% ex-Tesla, with the cost basis slightly below $38 a share. Thanks for watching. What do you think of Lemonade's Q2 earnings? Did they affect your thoughts on the company one way or the other? Let me know in the comments below. Thanks again for watching and have a great rest of your day.